Good morning, good afternoon, and good evening, wherever you are. My name is Philippe Savoy, and I'm Country Manager at Ebury Canada. Welcome to this webinar information session titled The Year of the Ox. What does it have in store for China? We continue to live in unusual times. The pandemic continues to have a grip on several sectors. However, there is light at the end of the tunnel. Recovery will be uneven across the globe, and the path forward seems to be a tad clearer. Against this backdrop, we have gathered some of our senior leaders at Ebury in an effort to share with you our views on the RMB and how some of our clients are benefiting from our advice. We are so grateful for our clients' support, so thank you very much. The webinar will have 4 sections. It will start off with Anand Ramachandran, Senior Dealer at Ebury in Canada. And Anand will walk us through a high-level development of the currency market, specifically CAD, US, and CNY. It will be followed by Isabelle Yi. Isabelle is Director of China Initiatives at Ebury in Europe. And Isabelle will be discussing the internationalization of the RMB and the impact on cross-border trade. This will be followed by Gianluca Privitera. Gianluca is a Senior Dealer at Ebury Canada. And Gianluca will walk us through 2 customer testimonials, how our customers have transacted in the RMB with their suppliers. Boris Delorme will finish up the session with a Q&A session. Boris is Head of Sales at Ebury Canada. To conclude, I would like to acknowledge the work and thank all frontline workers that have worked so hard during this pandemic. They are the true heroes. If you can keep your questions for the end of the session or just post them on the chat page along the way. On that note, I want to thank everyone again, and I'll pass it over to Anand. Thank you.
Thank you, Philippe. Good afternoon, everyone. I'll start off with Canadian dollar. Up until early last week, I think 2 primary drivers were moving the prices in dollar Canada. One was the singular recovery in oil prices. We noticed that oil was trading closer to 36.5 back in November of last year, recovered all the way up to 63.80 levels, up highs printed somewhere around in February. And the other aspect that was driving the prices on dollar Canada was the post-US election Biden administration that came in and created a situation where we had more stable political situation in the United States, leading to more risk on trades and sell-off in the US dollar across the board. So if you wind the clock back to November, we were trading close to 134 levels in dollar Canada in November. Going into December, we had already printed lows of 125.68. And after that, the market kind of stabilized, moved in a range, and then started moving further down. And Thursday of last week printed lows of 124.70. We also saw that on Friday last week, the market recovered 280 pips back up to 127.50 highs. Does this mean that the market in dollar Canada has more room to move to the upside? Is it going to stabilize here, or is the market going to move lower? That's the question. So if dollar CAD has to move higher from where it was, from the new highs that it printed back on Friday, I think 3 factors need to be considered. 1, US economic recovery. So we noticed that on Friday, the data that came out with GDP printing 4.1% against last time's print of 4%, durable goods orders significantly outperforming at 3.7% compared to 1.5% survey, and the continuing jobless claims numbers that came out lower than expected, all pointed toward early stages of recovery in the US market. And with that, and bond yields rising, notably the 10-year treasuries going up to 1.5%, we believe that this provided the buoyancy required for dollar Canada to move higher. Now, the other aspects to consider here is what's happening in US equities and what's happening in the bond markets. We believe that the move in the bond markets is primarily a technical move. We believe that Fed will continue to remain or maintain rates at low levels and only expect rate hikes 2 or 3 years hence. So this move in the bond market yield, I think driving US dollars higher is just a move that's happened last week. We don't expect this kind of a move to continue going into the future. US equity markets, QQQ, the technology sector ETF, corrected last week, moved below its trend line on the weeklies, and gave us a forward indication that there may be a correction in the US equity market. We believe that the correction will be no more than 10%, give or take, within this quarter or next quarter. So if that happens, even if we have a 10% correction, this could give further buoyancy to dollar Canada. The other aspect to consider is the price of oil, of course. So 63.80 is a pretty major resistance on the WTI NYMEX front month futures. If oil continues to trade below this level, this will mean a long dollar Canada trade for the weakening of the Canadian dollar. The last aspect that I think is really important is the pace of vaccine rollout in Canada, which admittedly has been fairly slow. Some changes have happened since Friday of last week, where the AstraZeneca vaccine was approved. And I think this would probably improve the pace of the vaccine rollout in Canada. But at this point in time, this is what I believe is going to lead to weakening of the Canadian dollar. Now, on the other side, on the flip side, I believe that the risk is significantly higher. So long story short, the view still continues to remain sell on upticks on dollar Canada. One aspect to consider is the price of oil. So March 4th meeting with the OPEC Plus is what's really in the limelight at present. And I think that the median demand for oil has continuously increased over the last year or so. We expect this trend to continue. And we believe that OPEC Plus will also continue to maintain supply at current levels or lower. And this should provide the impetus required for dollar Canada to move lower. So we believe that there is a breakout coming, possibly starting from this week or going into the next 2 weeks, about 63.80 levels. And if that happens, then we will see a significant sell-off in the US dollar against Canadian dollar. Fed continues to maintain rates dovish, and this is putting pressure on US dollar. And there is an expectation that a sell-off might happen in the US dollar. The other aspect to consider is the COVID-19 relief package, the 1.9 trillion relief package that came out, and what this means for the economy. So we believe that 20 to 30% of this stimulus is going to come back into the capital markets, and it's going to create a further buoyancy in the US equity market. And we believe that if this happens, if this trend continues, US equity markets, which is not currently a valuation play, valuations are completely overreaching at current levels. We believe that this is more a liquidity play, and this liquidity that's funneling into US equity markets is going to continue to drive equity prices higher, lead to further risk on trades where the US dollar gets sold across the board. The other aspect, finally, which is not on the screen to consider, is demand and supply. So from November to December, we moved on from 134 down to 126.67, 125.67 levels in December. And this left a lot of sell-side hedgers open to their risk. We believe that a lot of people did not cover this risk and were waiting for a level above 130 to sell into dollar Canada. And we believe that this is the reason the slide to the downside has happened pretty quickly as of last week, and we believe that every uptick will be sold into in this move. Please on to the next slide. Right, so here's a quick chart of dollar Canada on the weeklies and what this looks like. So as you notice, we've been in range-bound trading for quite some time now. We believe that 128.50 to 129.40 will be a fairly strong resistance level. And this is because of the demand-supply equation that we just discussed. I believe that sell-side hedgers will sell on upticks into this move, and that will create a cap for dollar Canada. By Q2 or Q3 of this year, I believe that 122 or 123 levels on dollar Canada might be seen. On to the next slide, please. Here's a quick chart of oil, WTI NYMEX front month futures. As you notice, over the last 1 year or so, we have a pretty major resistance at 63.80. And this is important now because we're currently trading close to 60.5 on oil. And with the OPEC Plus meeting coming up on March the 4th, we believe that if there is any chance to break this level, it would happen post this meeting. If not, it would trade below this level, and that'll give buoyancy for dollar Canada. But if prices move up, it's still a sell on uptick kind of a view. Next slide, please. Right, coming on to the yuan market. Instead of going into this point by point, long story short, I think the significant difference here is basically that the Chinese market is standing alone and standing out compared to the rest of the world in the fact that the pace of vaccine rollout is decoupled with their own economic recovery. So what I mean by this is most other economies depend very directly on the pace of vaccine rollout in order to improve their economic recovery. But the way China has handled the COVID-19 crisis has decoupled this need. Although they've only estimated about 300 million vaccines to be rolled out each year, we believe that their economic recovery is going to be much faster than the rest of the world. We've already started seeing this in Q4 numbers of last year, coming out at 6.5% of GDP versus the estimated numbers of 4.1%. We expect this trend to continue. And if we wind the clock back to November, we are trading close to highs of 6.76, and we've moved significantly lower on dollar yuan, all the way down to 6.40, 6.45 levels. Technically speaking, we're currently at 647. We believe that an uptick, if it does happen due to US economic data, would move the dollar RMB prices anywhere between 6.58 to 6.68 levels, possibly in the next quarter or in the next 2 quarters. But the move to the upside is expected to be short-lived, and this move would then convert into a pretty significant short on dollar RMB from there on out all the way down to 6.24 by the end of this year. That remains my view and the house view. So weaker RMB situation could arise if US economic data prints continue to outperform like we saw last week. If that happens, then we have a bit of an uptick on this pair. If US yields continues to rise on technical moves, once again, that would give some buoyancy to the pair. And the reason and the other aspect is capital measures. Capital measures still continue to remain stringent in the yuan, which is why there's not enough selling in the US dollar compared to the yuan as it could have been. What I mean by the last point is that the pace with which the yuan has appreciated could have been much faster if capital control measures were less stringent in the yuan. That being said, cases for a strong RMB, we still believe that the risk on demand-driven EM currency buying will continue. US political situation is still stable, expected to remain stable, and we believe that this will be a driver of selling US, buying RMB in the future. The other aspect is the Chinese economic stability and recovery, which we believe will be faster than other emerging markets and in general in the world. China also leads the way in curbing the COVID-19 crisis, and as I mentioned earlier, has decoupled itself from the pace of vaccine rollouts. Their economy is expected to outperform irrespective of what the pace of vaccine rollout is going to be. With that, I conclude, and I hand over to Isabel Yi, our Director of China Initiatives, who will speak to us about the internationalization of the RMB and what impact it's going to have on businesses in the future. Thank you.
Thank you, Anand. Hi, everyone. So I want to start my part on giving you an overview of what has been the process of the internationalization of the RMB. Because if you look back 10 years ago, probably most of the cross-border trade between China and the West was being settled in USD. Because at that time, RMB was a weak currency compared to USD, and the suppliers in China were very used to transact in USD. But we have seen how this situation has changed as China has embarked in the process of internationalizing its currency. So I want to make my highlights in 2 milestones here. First one, step 4, it's in October 2016, when RMB became part of the currency of basket of the International Monetary Fund. So previously in 2015, we saw how the RMB unpegged from the USD and switched to be pegged to a basket of currencies. And starting from that moment, we have been seeing more and more volatility in the exchange rate of RMB versus USD. and how the suppliers started seeing the impact of receiving USD and having adverse movements in its own currency. So that's why we are seeing more and more Chinese suppliers and their clients that are increasingly considering switching to transacting in RMB. So this has also been fostered by internal efforts by the Chinese authorities to push that its currency can be used more and more in the cross-border trade. So the second highlight I want to make on this slide, it's on the last step, number 7, which was last year, December, when the Chinese Central Bank released a notice where, among other things, it promoted the simplification of the suppliers receiving RMB for their exports. So previously, one of the hurdles that the suppliers had when they wanted to export in their own currency is that the bank requires them much more paperwork than when they receive in USD. So with this notice, the aim is to simplify this process so that the suppliers could submit electronic documents to the banks and make it easier for them to also export in their own currency. So if we move to the next slide, all these efforts are helping more and more buyers and suppliers turning into transacting in RMB. So when we help the buyers and suppliers to complete this process successfully, what are the reasons that we see for both parties to wanting to consider moving away from USD and transacting in RMB? So from the importer's view, one of the most important reasons is to ensure that when they import from China, they can get stable prices from the supplier and protect themselves from what we call one-sided risk. So I will elaborate more in detail about this in the next slide. But basically what it means is that the suppliers will potentially increase prices when the exchange rates are against them. But then when the exchange rates are favorable, the clients don't really benefit from a discount in prices. So that's why it makes sense to consider getting base prices of the supplier, which most of the times are going to be in RMB, because the factories are in China and most of the cost base is in RMB. So the best way for our clients, the importers, to get stable prices and get the total transparency on the prices that they could be getting from the suppliers is to ask for prices in their own currency so that they avoid this indirectly being exposed to the local currency of the supplier. This will give control to our clients on how they want to manage their foreign exchange risk. Because right now, a client in Canada, when they want to buy from China, they will be converting their Canadian dollars into USD, and then they will do whatever foreign exchange risk management tools. But then on the Chinese side, if the supplier is not doing the same, then they're still exposed to an RMB risk that is not being hedged by neither the supplier or the client. So if we go to the supplier side, one of the main reasons why they would be open to accept receiving in their own currency, it's also to protect against the negative impact of the dollar-RMB exchange rates, which recently, as we all know, the RMB has appreciated significantly against the USD. And because in China, the suppliers don't have a lot of access to the financial tools, the same way that we could have in Canada, and most of the suppliers, they cannot really hedge themselves because the bank only offers them fixed forwards that give them very limited flexibility. And also, if they enter into a FX forward with the bank, that will consume their credit line. And most of the times, because liquidity is a scarcity in China, most of the suppliers, they would prefer to use their credit line to borrow money from the banks rather than entering into an FX forward with their banks. Also, like by transacting directly in RMB and invoicing our clients in their local currency, they avoid the difficult conversations with clients of increasing their prices because of adverse movements on the exchange rate. So if we go to the next slide, here we're showing a real example from a European client of what has been the evolution of their USD prices throughout 2020. So this is a chart of what has been the evolution of dollar CNH rate in 2020. So if we start with the beginning of the year, so the client receives a price of 100 USD per unit from the supplier. So normally, how the suppliers set their prices in USD, because most of them would have base prices in RMB. So at the beginning of the year, they would normally take a budget dollar RMB rate that they would use to convert their base RMB prices into USD. So that rate is normally a bit below the current rate so that they ensure they have a small buffer if the exchange rate were to move against them. So the exchange rate that the suppliers told us they've been using in the last few years, for your reference, has been around 6.8, because actually before the sharp drop in 2020, previously the dollar RMB rate has actually been quite consistent between ranges of 6.9 to 7.15. So if we go to the beginning of January, right here, for simplification purposes, we would say that the supplier just took the current rate of that moment at the beginning of January 2nd and converted their base prices from RMB to USD. So their base price was 697 RMB, which divided between the rate at the beginning of January, 6.97, that gave them a price of 100 USD, which is what they gave to our clients. So the month passed, and we see how the RMB at the first half of 2020, it was actually moving weak against the USD. So the highest point of the exchange rate was in May 26, when 1 USD could change for 7.17 RMB. So at that time, the client continued paying our suppliers 100 USD, but the supplier was receiving not only 697 RMB, which was their base price, but they were getting additional 20 yuans because they were exchanging the 100 USD into 717 RMB. So they were getting the additional buffer. And if I ask those of you who import from China at that time, did you experience any price increase from your suppliers or any price discount? The answer from most of you will probably be no. So the prices were kept stable at 100 USD, and the suppliers were happy to get an additional buffer. So that's what we're saying here in the bullet A, that actually the supplier is benefiting from the additional margin that they're getting, purely coming from favorable movements in the FX market. But then now we move to scenario B, right? So starting in July, we started seeing the adverse movements of the RMB and then a strengthening of RMB versus USD. So in September, when the rate was at 6.75, so that's already below the budget rate that the supplier considered at the beginning of the year of 6.97. So now the supplier not only loses its previous buffer, but they're even getting less RMB than what they're supposed to do. So what happens? The supplier goes back to our client and asks for a price increase, and the price goes from 100 to 105, so that they can gain again the previous buffer that they had. So this is what we mean by one-sided risk. The client wasn't benefiting from the previous upside when the RMB was favorable to the supplier, but during the third and fourth quarter, because the RMB started strengthening, the client now has to share with the supplier part of the FX loss and then suffer an increase in RMB prices, because obviously the supplier hasn't really hedged and they're completely exposed to dollar RMB. So when things move the wrong way, then they go to the client and ask for an increase in prices. And actually, some of the suppliers that we liaise on a daily basis, what they tell us is that because most of the competitors around them, they know everyone is invoicing in USD, so everyone is in the same situation. Client doesn't really have much way to maneuver in terms of negotiating on the prices. And also, what we're recurrently getting from the suppliers these days is that there is an increase in prices because of the raw materials increase and also because of the FX. But it's not really clear what is because of what, right? So by asking for prices in RMB, we ensure that we know clearly the supplier is not increasing prices because of the FX rate impact. Because the raw materials increase, that would be like a separate question. So if we go to the next page, because of these adverse movements in dollar RMB, not only we have more and more clients that are asking suppliers whether they can provide prices in RMB, we're seeing as well more openness from the suppliers about receiving in RMB. So which are the factors that they consider? So firstly, the hedging capabilities, which I mentioned previously. Because the suppliers, they cannot really, most of them hedge with their banks, except if you're a very large company or a state-owned enterprise. That's why when we discuss with them the possibility of switching to RMB, and that client is actually able to hedge RMB as well, even though they are not in China and they could have access to RMB liquidity. That's something that actually for suppliers, it's a big plus, because then both parties will have their FX risk removed. Also, we have seen, if we look at across China as a whole in terms of regions, in general, the suppliers that are based in the major trading hubs that are located in the south and east of China, so we're talking about Guangdong, Zhejiang, and Jiangsu province, they normally have more exposure to receiving in RMB. And we see that the trend is for more and more companies there to switch to RMB versus companies, suppliers that are located in the northern area of China, so Shandong, where the suppliers there are still a bit more conservative, and the banks, they have a bit more issues when talking about receiving RMB. Then the volume that the clients have with the suppliers, that's also an important factor, because that will ensure the client has a higher negotiation power. As I mentioned as well in the first slide, because there's some more paperwork for the suppliers when they receive in RMB. If the client has a very small volume, let's say like 10,000, they are buying 10,000 USD per year from the supplier. So for the supplier, the incentive might be a bit smaller, right, to change their payment ways. But if it's a client that has a stable relationship with the supplier and they are asking to invoice in RMB, the supplier will always make their best efforts to accommodate to the client needs, especially because this is something that also benefits them. Also, for the suppliers that are already selling into Southeast Asian countries, we are seeing that some of them are already operating in RMB. So they have some prior experience about working in RMB. And then the latest point is on the sector that the supplier is. So most of the sectors that we've been liaising with, they are able and open to receive RMB. But there are certain sectors, if most of the raw materials that the suppliers use are bought from abroad, which they have to use USD, then it's a bit hard for them to be willing to switch to RMB. So we saw this very clearly, for instance, for the automobile wheels industry, where the base prices that they consider are in USD. So for that industry, for instance, it wouldn't make that much sense to switch to RMB. So if we go to the next slide, but for most of the other suppliers, they would be more open right now than ever to consider switching to RMB, also because of the adverse impact of the exchange rate. So even if they're open to receiving RMB, we still find some issues that they might potentially have. And here we have summarized what are the main questions that the suppliers could raise when our clients ask them about switching to RMB and how we could help with this. So first and most common question that we get from the supplier is whether they can get their tax refund if the client pays them in RMB. So this is a very common misconception that the suppliers used to have, although I have to say that more and more suppliers, they are getting to the realization that it's a misconception, which is that if they export in the local currency, would they lose the VAT rebate that they could get from the tax authorities? Because for all the products that are manufactured in China, the supplier needs to pay a VAT, which they can later get the refund from the tax office when they export it. So as long as the RMB is received on a cross-border basis as an export, the suppliers can still get their VAT refund regardless of whether they're receiving in RMB or in other foreign currency. Because when you receive RMB from abroad, it's also considered a foreign currency. So there will be no issues at all with the VAT rebate. The second one is suppliers complaining because they're getting a lot of paperwork from their bank, which is very time consuming for them. So with this new guideline, which I mentioned that was released at the end of December last year, and that the measures came into force in February 4th this year, the idea is that this will significantly simplify the paperwork for the banks. So it would be a bit easier for the suppliers to receive directly RMB, because this is also something that the local authorities in China are promoting. And then last but not least, there are certain suppliers that even though the factories are in China, they receive through their bank accounts that are offshore, most of the times in Hong Kong. So for these suppliers, although they could potentially receive RMB directly in their bank account in Hong Kong, they have a lot of difficulties to send RMB directly from Hong Kong to China. So for this sort of suppliers that receive through an offshore account, Ebury has developed a unique solution called Parallel Forward that enables both client and supplier to protect against the RMB risk. The supplier is still able to provide prices in RMB to the client, but the supplier can have the choice to receive USD equivalent, so that this satisfies their problem of not being able to receive RMB directly through an offshore account. So because of time constraints, I won't go into too much details here, but you're welcome to go to any of your relationship manager or contact person at Ebury to get more information about this. So this would be the end of my part. I'll pass it now to Gianluca that will be sharing some client testimonials.
Yeah, thank you very much, Isabel. Hope everyone can hear me okay. Yeah, I want to leave enough time for Q&A.
Hey, Gianluca, there's like a bit of an echo.
Oh. Hang on. Is that better?
Yeah, I think, yeah, let's just carry on. So meanwhile, I just want to remind you, because we'll leave some time for Q&As. If you have any questions, please raise them in the chat. And we're looking forward to questions. So the most difficult, the better.
Yeah, sorry, can you hear me now, everyone?
Yeah, perfect now.
Okay, sorry about that, a little technical difficulties. But yeah, so there's an interesting case that I wanted to go over. I'm sure it's obvious the examples that Isabel gave with clients who are in Canada sending US dollars to China and taking on that FX risk going from Canadian to US. I had an interesting case here of a client who has been in business for over 20 years and they were not doing any FX transactions, but you'll see here that they were actually indirectly exposed to FX risk. And so basically this client was in the cooking products industry. They're manufacturing these parts and importing their main components from China. They sell abroad. Their main customer base was in Canada and the US. So they decided at the time of inception to go with US dollars as their denomination for their business. They received US dollars, they paid US. So they thought they had a natural hedge. And up until last year when we made contact with them, they had no idea that the FX rate was actually playing a part in their foreign exchange. So once we reached out to them, we took a closer look. We did a historical cost analysis, and we quickly saw those asymmetric price fluctuations that Isabel was kind of showing you guys in her examples. So when the Chinese renminbi would strengthen, the supplier was pretty quick to actually increase their prices on them. But when it went the other way and you saw some periods of Chinese renminbi weakness, the supplier pretty much never lowered their prices and instead just took that and padded their margins. Can we just jump to the next one? Perfect. Yeah, so it clearly showed that even though there was no foreign exchange on their books at all, everything was US to US, the USD CNY exchange rate was clearly a source of risk to the company. So the client may have had a natural hedge against transactional risk. It was completely exposed to economic risk, meaning that even though on a transaction by transaction basis, they weren't doing any FX, every time the exchange rate would fluctuate, this would end up adversely affecting their margins. So what we did, we ran that analysis with the client. They quickly went to their supplier in China and they began negotiating to fix the invoices on a quarterly basis. So by getting billed in Chinese renminbi, the client that we had now effectively gets to take control of their FX risk. So it's hard to hedge economic risk on its own. By taking on the transaction portion of the risk and getting billed in the same currency, both sides were able to lock in the margins that they felt were appropriate for each quarter. And everyone turned out to be quite happy. Everyone was able to take the FX portion out of the equation and yeah, it really improved their supplier relations. So that's all I really wanted to jump in and share here. I think it's a good time to jump into Q&A. So Boris, do you want to take that over?
Yes, hi there everyone. So thank you all for presenting your part. Are there any questions at this point in the audience? So I see one coming in, and Anand, I'd like you to answer this question. And
Sure.
The following. So how low do you see USD CNH or USD CNY go by the end of 2021 and maybe even into 2022?
I mean, it's difficult to predict, but I would say 6.24, 6.25 by the end of this year. And yeah, that's primarily because this is not really uncharted territory. And we have made a low of 6.25 in the past, I think back in 2018. And I believe that that'll be the next major support on dollar RMB. So I think I would say safely, maybe closer to 6.25. But if US markets begin to recover, I think we'll get a spike up and then a move lower from there. And that I believe seems to be my view. Yeah. Going into 2022, it's hard to say. But yeah, if we go below 625, the slide could easily take us to 6.0 or at least 6.10. And I think that's my view. Thanks.
Another question. How is the analysis completed with the client? What do you request from them in order to do the analysis? I'll leave this one for John, I guess.
Perfect. Yeah, thanks. So in this case, because they had years and years of dealing with the same client, what we did was we told them to go back to their financial
Gianluca, I hear like a weird noise. I'm not sure if it's me or does the sound okay for you, Anna?
No, it doesn't.
Yeah, there's like a very weird buzz in the background. It was already happening with Boris previously. No, it's still a bit odd.
Hey, Isabel, do you want to, I don't know if you must have done a couple of these, maybe you want to take my question?
Yeah, sure. Maybe I will start first because there's two questions from Andrew on the chat. So he's saying, as a buyer, can I hedge RMB exposure in forward FX market? So maybe Anand, you could reply to the first part.
Sure, I could take this.
The second.
I mean, we're trading 647 if it breaks to the upside from here. And if we close above 6.49, I think you get a retrace back up to 6.58. That seems to be a best case scenario. So if you do get that trigger with US economic data coming out this Friday, and if that trigger does occur, then I would say wait and short into that move. And I mean, that's the way I would play it. I would wait for that uptick, and then I would sell into that uptick, and I would sell in for longer tenors rather than shorter tenors.
Yeah, and to build up on our RMB specialty. So actually, like 80% of our clients, they transact with China, and we already have 10% of them that are transacting in RMB. So we actually have a very good liquidity in RMB, and we can actually provide client RMB hedges of up to quite a long period, like 3-5 years, so that we could provide you the CAD RMB or dollar RMB solution. So on the second part of Andrew's question, I have a dilemma going on from USD to RMB. At what point would I want to trigger this? At the moment, I'm gaining because the dollar is weakening and Chinese suppliers are losing out. If I wait, the USD may weaken further and we lock CAD RMB at a more favorable rate. So,
sure, I guess I could take this again.
Yeah,
the question is, where is your exposure? If your exposure is CAD RMB or is it dollar RMB? So if your exposure is on CAD RMB, the view on dollar CAD is that it's likely that it might move lower from these levels. If that does happen, then you might get the spike up in CAD RMB to sell into that move. If your exposure is dollar against RMB, then it makes sense for you to hedge out some portion of your exposure at current levels, because if the market dips from here, it might be a quick slide. Or if the market moves up from here, I would wait to see what US economic data is over the next 1 or 2 weeks to see if we get an uptick in dollar RMB and sell into that uptick. So that's the way I would probably consider hedging this.
okay, thanks, Anand. So there's another question from Elias. How is the analysis completed with the client? What do you request from them? So I imagine we're talking about the analysis of whether switching to RMB. So basically, we would always encourage the client to open the conversation with the suppliers, regardless of whether we finally decided to switch to RMB. It's always good to see what's the supplier's view and also what sort of RMB prices that they could provide. So we can either have a one-on-one session with the client to give them some advice on how they should tackle this with the supplier, or we have a specialized RMB team that can help our clients to negotiate with the suppliers and then explain them the procedure of RMB and how this could potentially be a win-win situation for both parties. Then on the next one, what is the first task with multiple vendors to transact in RMB as a supplier? So let me rethink again about this question. So what is the first task with multiple vendors to transact in RMB as a supplier? So if we're talking from the supplier's view, right? So if you're a supplier in China that has never received in RMB before, you need to go to the bank and make sure that you enable the functionality to receive cross-border RMB directly. So normally for all the companies in China that have an export license and already have a USD or foreign currency account with their bank that allows them to receive money on a cross-border basis, they just need to enable the functionality to receive RMB as well. And then that should be done. So from the client's perspective, if they want to start having this conversation with the suppliers, for clients that has like multiple suppliers in China. So we normally suggest to concentrate in the few big ones or the ones that they have a good relationship so that they can test the waters first and see what is the supplier's view on this. And then we can see once we get a few data points from the major suppliers, we can speak to the rest and see like whether we can convert them and what is the rate that we could negotiate. how do you schedule these payments in RMB when we have scheduled payments done to suppliers? So normally for clients to start transacting in RMB, because the supplier needs to make sure that the contract, the invoice and everything is directly in RMB, we would suggest to start with new orders. So if we're talking about an outstanding order that client needs to make a payment in USD, it will be normally hard to switch to RMB directly because suppliers might potentially have issues with the tax office when getting the VAT refund. So it's best to negotiate with suppliers about switching to RMB for new orders where there are no payments yet. And then this one, I think, Anand, is for you. We convert CAD to USD to pay overseas suppliers. Do you recommend Target?
I guess this just comes down to how you manage your hedging. It depends on whether you're, I mean, if you have to make a payment to a supplier right away, you have to make that payment. So if you have future payments that are lined up, at some point you could consider hedging when prices become more in your favor. So at this point, if you have a payment to make to the supplier, use spot. Maybe use limit orders. That is what I would recommend because the volatility in dollar CAD is pretty high. So the chances are you might get filled on better orders. We could discuss that in more detail in the future. But for hedging, I would suggest that you consider waiting a little bit and then buy into those moves and lock in better prices to pay your suppliers for the future.
So we have one last question. If we have factories who do not have foreign currency bank account, so this goes back to what I was mentioning on the supplier issues. Those suppliers that would be receiving from an offshore account, normally in Hong Kong. So these suppliers that receive from Hong Kong, or because they don't have a foreign currency bank account in mainland China, normally we would identify them because a lot of times they ask our client whether they can be paid into a personal account in China. Personal account because they don't have the corporate account to receive directly from their exports. So this is where the parallel forward, the solution that Ebury has, comes into place. Because for these companies, even they don't have the foreign currency bank account in China, they would have it somewhere else in an offshore account in Hong Kong or elsewhere. So we can still pay them their USD equivalent, but with the pricing directly in RMB so that we make sure that the risk here is protected.